Right? If you take, let's say, in Indian market, we've been fairly lucky. If you see the last 10 years, we have had a good bull run. 2004, 5, 6, 7, we had a good bull run. We had a sharp bear rally in 2008, market in North America. And for the last 4 or 5 years, we had a very range-bound market. So we had a bull run, we had a bear run, we had a range-bound market. So we have all sort of data to play around it, right? And actually to optimize our strategy. Now the idea is that you need to take this data and then basically test your strategy. Instead of putting your money into the live market and actually losing money and losing your head first, it's important that you can just take that simple data and do the calculations on your Excel. I'm not even asking you to make programs. You don't need to make super computers. You just can take it in the Excel and do a simple calculation and figure out whether this strategy or this rule has worked in the past. If it has worked in the past, then the chances of it working in the future is high. Alright. You can also go a step above. You can say that the strategy looks good to me, but it has not worked in the past in certain kind of market. Can I apply some other rule on top of this? Right? Can I apply some other rule on top of this to further refine my trades? For example, if you do a moving average kind of a strategy in a range-bound market, you will end up losing money. Why? Because in a range-bound market, the moment your crossover happens, you end up going long. Again, the market goes down, you end up having a stop loss. Again, your moving average has a crossover on the lower side, you end up again having a loss because you short the market, again the market goes up. So you end up having continuous losses in a range-bound kind of a market. Can you also put a layer on top of that saying that, I'll put my moving average only when the market breaks the 20-day high. Right? So now you've got two layers of rules. One is your moving average, and the other is also the market should have broken the 20-day high or have made a new low, a 20-day low or a 10-day low for me to enter into the trade. That way what will happen is you'll end up filtering out those areas where the market is in a completely range-bound market and you'll not end up losing too much of it. Right? But these kind of rules will only come if you have the data of the past and you apply a new rule on it. Right? The idea is basically one rule on top of the other and simple rules. Again, nothing very complex. Something very simple that you can actually work on with the execution. Right? But if you apply one or two simple rules that you've thought of or you've given the thought in your past and you understand that this is the kind of rule that needs to be applied, you can end up making really, really good systematic strategy. That is basically the idea. Again, talking about data, whenever you take the data for doing any kind of, backtest for a systematic strategy, the most important factor is don't take the entire data. Don't take the entire 10 years that you've got and optimize it on that. Right? What we basically say in the technical terms is that you keep an in-sample data and you keep out-of-sample data. When I say in-sample data, you basically keep some data, for example, 70% of the data on which you do the testing. So for example, if I've got 10 years worth of data, I would ideally take 7 years of data and do my testing and optimize my parameters, what moving average I need to apply, what breakouts I need to apply, what stop losses I need to apply. I'll do all the optimization on these 7 years worth of data. Once I have the strategy with me, that this is the strategy I've got, you apply it on the blind data, which is the 3 years of data, to see if your rules are consistent. Whatever has worked in 7 years, has they worked for the remaining 3 years also. Right? So the idea is, you've got in-sample data, you've got out-of-sample data. In-sample data is where you do the testing and the optimization. And then you apply it on the out-of-sample. Alright? Again, we'll get back to some more systematic strategies and discuss that. So everybody is clear with trend following system, why you need to do trend following systems, how you can develop simple trend following system, how you can use volatility as a stop loss. Alright? Now we'll see another kind of a strategy. Which we basically call as arbitrage strategies or paid trading strategies. Okay? Now they are like the two sides of the same coin. Trend following system is something that will work for 30% of the time, 35% of the time, and will not work for 60-65% of the time. And whenever they work, you need to do it in good size. Paid trading or arbitrage are the kind of strategies that will work for 70-75% of the time. Alright? And that's the reason why you need to do them on unit size. You don't need to increase your bets on them. Alright? I'll explain. Suppose I take these days arbitrage or paid trading strategies are working very well on public sector banks. Again, you need to be very specific. You need to take very non-news flow kind of stocks. Public sector banks. जिसमें अगर news आएगा तो it will come on the entire sector. It will not come on Punjab National Bank or Union Bank or something like that. When was the last time you heard any news on Union Bank? Similarly, you need to take stocks like ITC, Dabur, Hindustan Lever, which are like very very low beta and they keep moving in tandem with each other. Or take Cipla, Samssara, Dr. Reddy, which again move in tandem. So something which are like low beta or somewhere where the news events are not very high. Not something like DLF and JPS, so it never works on DLF and JPS. Not something like even private sector banks, ICICI, HDFC Bank, it never works because these banks have got so many internal problems, management issues, this, that they keep on that. So you need to take, again you need to be very specific. You need to be very specific in terms of the kind of stocks you take. Alright. So we'll take a small example. Suppose I take Dabur and I take Hindustan Lever. Alright. Dabur, Hindustan Lever, both are FMCG companies, supposed to move in tandem with each other. You never hear, forget about the earning announcement, but beside earning announcement, you never hear any major news about them. Dabur I have not heard in the last 6 months any major news. Hindustan Lever I have not heard any major news. Right? So they both move in tandem with each other. Very sort of even if a large mutual fund manager has to buy an FMCG, they'll buy both the stocks, right? And that's why they'll always move in tandem with each other. So during the market hours, let us assume that every day at the end of the day, I am calculating their end of the day price, okay, of Dabur and Hindustan Lever. So suppose again I'll take some random numbers. So I've got Dabur and I've got Hindustan Lever. Alright. Today is 23rd Feb. So let me just say 1st of February. I record their price. You can see the board. Suppose that the Dabur's price was say 100 rupees. I'm taking some random numbers just for the sake of calculations. Hindustan Lever's price was supposed 200 rupees. Okay, this was at the closing of 1st of February. Alright, 2nd of February. Suppose this price was 101. Suppose this price was 202. 3rd Feb. Suppose this price was 99, this price was 201. Today, which is let's say 22nd Feb, suppose this price was 96 and suppose this price was 198. Alright, you've got the daily end of the day prices. Right? Now what you need to do is you need to identify an arbitrage opportunity. You need to identify when exactly they are diverging, when exactly they are converging. Whenever they are diverging, for example, suppose during the market hours, some fund manager randomly comes up and he has got a huge stake in Hindustan Lever and he wants to sell it. He doesn't care about where Dabur is. All he's bothered about is selling Hindustan Lever. Right? So you would see during the market hours, in the short term, Hindustan Lever goes down, but Dabur stays where it is. And then there is a dispersion. The moment there is a dispersion, it becomes an opportunity for you that you buy into Hindustan Lever and you short down. Till the time they again converge. Right? So you're trying to play on the moment there is a divergence, you're trying to buy when you're trying to sell other. The moment there is a convergence, you're trying to unwind. Okay? The beauty of this lies in the fact that you're buying one stock, you're selling another stock. So you are in any way rupee neutral. If you're doing this in equal value, rupee value, suppose one lot is of 3 lakh rupees. If you're buying into 3 lakh rupees worth of one stock and you're selling 3 lakh rupees worth of another stock, you're rupee neutral. So tomorrow if the market gaps down by 2%, it will not bother you because your shorts will make money. If the market gaps up by 2%, it will not bother you because they long term. So you are rupee neutral. Right? Most of the bigger fund managers in Europe and US, these days they play these kind of rupee neutral strategies, which we call as a long short kind of strategy. The idea is that if the markets are not giving you any return and are staying where they're staying, you cannot go long in Bitcoin. So you need to basically do something of this kind, right? Where basically you're not impacted by the daily gyrations of the market, but still you end up being consistent amount of it. Alright. The second major advantage is you're sector neutral. You are within the same sector. Hindustan Lever and Dabur are within the same sector. So any major news in that sector will impact both the stocks in the same. So A, you don't have a market risk. B, you don't have sector risk. The only risk you have is the stock specific risk. Alright, the only risk that you have is tomorrow if there is some news event in Hindustan Lever, you will have some kind of a drawdown. Alright, or if you have some news in Dabur, you will have some kind of drawdown. Which again you can mitigate by taking those stocks which in any way don't have news coming for 6 months. Right, so the only other risk that you are remaining with is the earning risk, which happens 4 times in a year. So during the earning season, don't do that. But besides that, you've got all the other time available for you to actually trade in these stocks. right? So no market risk, no sector risk, and very minimal stock risk, and very consistent sums of money that you can make on these stocks. Don't do it on DLF, JP Associate, because they have news coming out every day. Right? DLF will move up by 20%, JP Associate will go down by 20%. And then you say, this kind of divergence I cannot. Obviously, it will happen because they are stocks of those names. But so do it on low beta stocks, do it on stocks which do not have too much of news flow, not too much of events happening. Okay? And you can actually end up being consistent. Just the way I told you that trend following systems, do it on stocks which are very high, which moves 4-5% wildly every day. Because only on those kind of stocks you can actually make money on trend. And these stocks you do it on low beta stocks. No new events. Right? So here, again coming back to this, I've got Dabur, I've got Hindustan Lever. Now I will define something which is called the ratio of these two stocks. Alright? So what is the ratio here? 100 divided by 200. So 100 divided by 200 is 0.5. Okay? 100 rupees divided by 200 rupees is 0.5. Okay? 101 divided by 202. Again, I'll take some random number. Suppose 0.51. Okay. 99 divided by 201. Suppose 0.49. Right? All the way, duck. Suppose this number was 0.45. Now, for the last 20 days, with respect to 22nd February, for the last 20 days, I have the ratio. Alright, I have the ratio of stocks. Can I remove this part? I can define the average of these ratios. Right? What will be the average? Just the way we have seen the average of all the numbers. You know, when we are doing the Nifty's return for the year, you can calculate the average. Suppose this average comes to 0.5. Alright? Suppose the average comes to 0.5 of all of these. Now what does it tell you? It basically tells you that the ratio of Dabur to Hindustan Lever on an average has a ratio of 0.5. The price of these two moves at a ratio of 0.5. Alright? But during the market hour, because somebody wants to sell off Hindustan Lever, somebody wants to buy Dabur, somebody wants to sell Hindustan Lever, this ratio will not be at 0.5. It will move. It will have variations. Sometimes it will go below 0.5, sometimes it will go above 0.5. Right? We need to identify the entry point. We need to identify at what point in time we want to enter into this particular trade. Alright? So the first rule is that you calculate the average and then you also calculate the standard deviation. Suppose the standard deviation comes out to be 0.0. Okay? Again, any question on standard deviation? We have just done the calculations there. You do the STDEV of all of these numbers, you will get the standard deviation. Alright? So if my standard deviation is 0.02, that means with respect to my 0.5, what is my 95% confidence interval? With respect to 0.5, I can go down by 2 times of 0.02, which is 0.04. Okay? So 0.5 minus 0.04 is 0.446. Right? So I can go down to 0.46. But with a 95% confidence interval, I can say that I will not go down below 0.46. There is a 95% confidence interval that I will not go down below 0.46. And on the upper side, 0.5 plus 0.02 into 2, which is 0.04. So this comes to 0.54. Alright? So there is a 95% confidence interval that this ratio is going to stay between 0.46 and 0.54. As a trader, you are only interested in the remaining 5%. As a trader, you are only interested if the ratio falls below 0.46, that means it goes to this area, or goes above 0.54, that means it comes to this area. It comes into a territory which is unsustainable. From there, the chance of this particular ratio bouncing back is very high. You are looking at probabilities here. You are looking at what point in time should I enter into this trade such that I have a higher probability of being in the money. When I put this particular trade, I am in the money with a higher probability. Alright? So the first rule is that you enter into this particular trade if your ratio goes below 0.46 or goes above 0.54. If it goes below 0.46, right, and if you have defined your ratio as Dabur's price divided by Hindustan Lever's price, correct? And if your ratio has gone below 0.46, which one would you buy? And which one would you sell? You're buying one stock, you're selling the other one. And if your ratio has gone down, and if you have defined your ratio as Dabur's price divided by Hindustan Lever's price, which ratio would you buy, and which stock would you buy, and which stock would you sell? You'll buy Dabur? You'll buy Dabur and you'll sell Hindustan Lever? Any question on that? Why you do something like that is because the ratio has gone down too much, right? If the ratio has gone down too much, probably your Dabur has gone down too much. Or your Dabur is at the same place, your Hindustan Lever has gone up too much. Either way, this ratio is going to go down. Alright? So if the ratio has gone down, probably your Dabur has gone down. So you are buying into Dabur and you are selling Hindustan. And whenever you do this in equal rupee value. You buy into one and you sell the other in the same rupee value. Not same quantity, not same size, not same volatility, nothing, just rupee value. 4 लाख का ही खरीदा 4 लाख का होगा, 10 लाख का ही खरीदा 10 लाख का होगा, right? No hanky panky. Alright? If your ratio has gone too up, it's gone above 0.54. Which one would you buy? Which one would you sell? You'll sell Dabur and you'll buy it. Alright? Any questions? Here, what we'll do is we'll define. So, every time looking at 3 different numbers is a very complex thing. You're looking at what is the current ratio, you're looking at what is the average, you're looking at standard deviation. Every time monitoring so many things becomes an issue. So we'll define a single number here, right? Which in technical terms we also call as Z-score. Alright? The Z-score is basically defined as the current ratio minus the average of the ratio divided by the standard deviation. Current ratio minus the average divided by the standard deviation. So here, in this case, suppose my current ratio was 0.45, alright? So my Z-score becomes, my current ratio was 0.45. What was the average? 0.5. What was the standard deviation? Alright? What does this number come out to be? It comes out to be about minus 2.5, I think. Alright? Now the idea is, this Z-score is a very, very important number. This Z-score is the number that most of the time stays in between -2 and +2. Your confidence interval of 95%, right, is what it basically signifies. How much is the confidence interval is what it signifies. So if it stays in between +2 and -2, that means it is within the 95% confidence. The moment it goes below -2, alright, the moment it goes below -2, that means your current ratio has gone down too much. Alright, so if your current ratio has gone down too much, this Z-score will fall below -2. So if this Z-score falls below -2, you basically enter into this trade by buying Dabur and selling Hindustan. If your ratio goes up too much, if your current ratio goes up too much, too high, suppose it goes to 0.51 or 0.52, this Z-score will move above +2. The moment it goes above +2, right, you sell the Dabur and you buy into Hindustan. Alright? So here, instead of looking at 3 different numbers, which is the ratio and the average and the standard deviation, you are only looking at one number, which is the Z-score. Right? So you enter into the trade when the Z-score falls below -2. What do you think should be your take profit? Where would you unwind the trade? Any idea? You have entered into the trade when the ratio was 0.45. Alright? You are expecting the trade to again converge back. When you say converge back, what do you mean? Converge back to the Z-score of 0. That means converge back to the average price. If your average was 0.5, alright, that means the moment your ratio goes back to 0.5, what will happen to your Z-score? What will happen to the Z-score value? 0.5 minus 0.5. It becomes 0, which means you enter into the trade when your Z score falls below minus 2. You unwind the trade when the Z score comes back to 0 or goes above 0, at that point. Most people, they enter at minus 2, they wait for plus 2 to happen. So it's like from convergence, why would the divergence happen? You're just waiting for the fact that the gyration that is there has stopped and it has come back to its average. The moment it comes back to the average, you want to unwind. Alright? So you enter into the trade when the Z score falls below minus 2. You unwind the trade when it again comes back to plus 2. Comes back to 0. Alright? You have a stop loss of when the Z score goes to minus 2. So you enter into the trade at Z score of minus 2. But if your trade goes to minus 2, if your Z score goes to minus 2, you unwind it. What is the reason? Why are we doing this? See, minus 2 and plus 2 is a 95% confidence. Minus 3 and plus 3 is a 99% confidence. Which means with 99% probability, this Z score should not have gone to plus 3 or minus 3. But because it has gone, that means something uneventful is happening with this trade. Probably there is a news, there is some funding announcement, there is some XYZ thing happening between the hour and Nissan level, which is what we are not able to recover. So we need to have a stop loss in place. Alright? So instead of defining again our stop loss in terms of fixed percentage, you define that in terms of Z score. So your entry is at minus 2. Your take profit